Okay, today I want to discuss equity or shares or stock or whatever you want to call it is, and I understand this is probably going to be a pretty simple sounding one. It's part of a company and it costs money, and when the company does well, the company is worth more, so your share of the company is worth more. And then when the company does badly, the opposite happens. Easy. Well, there are a couple of things wrong with this. Firstly, in the market, expectation of future events plays a huge role, especially in the short term. Perhaps a company is in an early stage and it isn't making money at all, or perhaps it's even losing money, but it still has a market value. It still has a share price. And that's because participants in the market, those people like you and me who buy and sell shares, believe the company will do well in future. You see a lot of this with tech companies, and then you have the opposite. Companies exist that make lots of money, but the market believes there isn't room or much room for a lot of growth. A good example of this are the large oil companies, oil majors like Shell or BP. Or even that in the distant future, certain companies will contract or even die off, and tobacco companies are ones that fit the bill here. However, when a company is large and makes a lot of money and can't usefully spend that money on anything, on growing itself or whatever else, it might then return some of that profit to shareholders in the form of a dividend. Okay, so when a company does well, the price goes up. When it does badly, the price goes down. And some companies pay out a regular amount of money as income. It's starting to sound a lot like a bond. So what is the real difference here between a bond or debt and equity or shares? Well, with equity, the directors of the company owe you a very nebulous and non-specific thing, which in legal terms is called a fiduciary duty. Essentially, they have to act at all times in your best interest, but don't owe you anything specific beyond that. They don't owe you your money back. They don't owe you any particular job performance or working hours. They just have to make the value of your shares go up at some point in the future. And this is where it all gets a little bit tricky, because there are no legal parameters to this. For example, what happens if the fiduciary duty involves acting unethically, not paying a supplier on time so the supplier goes bankrupt and the debt never has to be paid? I suppose you could say the company will get a bad name or reputation in the long term and people won't want to do business with it, so it'll be worth less then, but that's in the future and it's unpredictable. But doing over a financially weak supplier is money in your shareholders' pockets today. And here's what's sometimes happening with regard to an acronym you may have heard of, ESG. It stands for Environment, Social and Corporate Governance. ESG is something that many boards of directors now consider when making decisions for the company that they run. But this is necessarily something other than a consideration for what is most profitable for a company. For example, if an oil company makes a business decision and it takes into account when it makes this business decision climate change. For example, it might invest money into solar power, and let's assume that in this example solar power is a less profitable way to make electricity than oil production. Now, that may very well be bad for the oil company. However, an ordinary shareholder of that oil company will own more than just one share. They will, on average, own shares in dozens of other companies. In fact, the average shareholder will indeed own shares in index funds or mutual funds that will in turn own shares in thousands of other companies. And if the world, through climate change, heats up too much or in some other way becomes broadly worse, that'll be bad for all those other companies that the shareholder owns. So the fiduciary duty of the oil company's directors might be to act against the best interests of that specific company, because to do so means acting for the best interests of all the other companies that that average shareholder is likely to own. This sounds really strange and very theoretical. But we do have this situation at the moment with the governance aspect of ESG with Elon Musk. Now, Elon Musk was contractually promised about $50 billion through stock options, and the stock option said that he got the $50 billion if he made the share price of Tesla go up enough, which he did. But the Delaware court in question said that this wasn't in the best interests of shareholders. Even though the shareholders actually voted for it, the judge said they weren't fully informed. But what if Elon says that now, instead of developing whatever idea he's got, the latest and greatest new technology inside of Tesla, he does so inside SpaceX? What if a shareholder wants the stock to go up a bit today and doesn't care about it going up much more next year? The reality is, with fiduciary duty, because there's no time limit or expiry date, maturity date like a bond, it's impossible to know how to exactly measure it. That's all for now. In my next video, I'm going to go into some detail about value versus growth investing and why diversification isn't always a good idea. Thanks for watching.